Hey, what's up, stock compounders? Brad here. So today I want to talk about a chapter in one of my favorite books, The Most Important Thing Illuminated by Howard Marks. Uncommon Sense for the Thoughtful Investor. This is one of the first value investing books that I ever read. And Warren Buffett had this to say about The Most Important Thing. This is that rarity, a useful book. Okay. Now, the most important thing, it's kind of a joke. Howard Marks writes frequent memos to his investors, and he usually starts these memos by saying the most important thing is, and he says it about something different in every memo. And in this book, it's sort of a compilation of his most important things. There's 20 different most important things in this book. And today I want to talk about the most important thing is being attentive to cycles. This strikes me as particularly relevant to the investment environment today. So I just wanted to share some of my highlights from this chapter on cycles in investing. I think it's essential to remember that just about everything is cyclical. There's little I'm certain of, but these things are true. Cycles always prevail eventually. Nothing goes in one direction forever. Trees don't grow to the sky. Few things go to zero. And there's little that's as dangerous for investor health as insistence on extrapolating today's events into the future. Of course, there's a number of stocks that I'm watching where it seems like investors in those stocks are extrapolating into the future as far as the eye can see, what's happening today, how well those companies are doing today. So there's a lot of danger in that. The more time I spend in the world of investing, the more I appreciate the underlying cyclicality of things. There are two concepts we can hold to with confidence. Rule number one, most things will prove to be cyclical. Rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. So if you understand that things are cyclical, it can be a real advantage to be able to spot when other people don't see it that way. That can produce some incredible opportunities. The basic reason for cyclicality in our world is the involvement of humans. Okay? People are emotional and inconsistent, not steady and clinical. The extremes of cycles result largely from people's emotions and foibles, non-objectivity and inconsistency. This is one of the things that make Warren Buffett and Charlie Munger that gave them such an incredible track record, because they've worked exceptionally hard at staying rational rather than getting swept up into the emotions that are really easy to get swept up to in the world of investing. The credit cycle deserves a very special mention for its inevitability, extreme volatility, and ability to create opportunities for investors attuned to it. Of all of the cycles, it's Howard Marks' favorite, the credit cycle. It takes only a small fluctuation in the economy to produce a large fluctuation in the availability of credit, with great impact on asset prices and back on the economy itself. So here's the process. The economy moves into a period of prosperity. Providers of capital thrive, increasing their capital base. Because bad news is scarce, the risks entailed in lending and investing seem to have shrunk. Risk averseness disappears. Financial institutions move to expand their businesses, that is, to provide more capital. They compete for market share by lowering demanded returns, for example, cutting interest rates, lowering credit standards, providing more capital for a given transaction, and easing covenants. At the extreme, providers of capital finance borrowers and projects that aren't worthy of being financed. That's a great way to know when we're in bubble territory, when money is that easy to get. This leads to capital destruction, that is, to investment of capital in projects where the cost of capital exceeds the return on capital, and eventually to cases where there is no return of capital. When this point is reached, the up leg described above, the rising part of the cycle, is reversed. This is when the cycle starts to go the other way. Losses cause lenders to become discouraged and shy away. Risk averseness rises, and along with it, interest rates, credit restrictions, and covenant requirements. Less capital is made available, and at the trough of the cycle, only to the most qualified of borrowers, if anyone. Companies become starved for capital. Borrowers are unable to roll over their debts, leading to defaults and bankruptcies. This is the big reason why it's risky to invest in companies that have significant debt, because when credit dries up, that's when those companies can default, go bankrupt. If you're investing in companies that don't have debt, that's not a risk. They can move through those down cycles. So it's really important. This process contributes to and reinforces the economic contraction. Of course, at the extreme, the process is ready to be reversed again. Because the competition to make loans or investments is low, high returns can be demanded along with high credit worthiness. You get higher return and lower risk. This is one of the secrets of value investing, that combination to be able to get higher returns with lower risk of losing money. Most investors, and particularly what they teach in finance programs in universities, is that you can't have both high return and low risk. They're kind of trade-offs that you have to manage. Look around the next time there's a crisis, you'll probably find a lender. Over-permissive providers of capital frequently aid and abet financial bubbles. Right. Investors will overvalue companies when they're doing well and undervalue them when things get difficult. Imagine that. So right now you have companies like Apple, you have companies like Tesla, companies like Facebook and Google. Those companies are doing really well. You look at them, particularly if you look at what other investors think of them, what the stock prices have done in the recent past. You look at them and you think, wow, these companies can't lose. They can't miss. They're on fire. Well, that's when it's easy to overvalue those companies or to build excessive expectations into the future around those companies. Every decade or so, people decide cyclicality is over. Okay? They think either the good times will roll on without end, or the negative trends can't be arrested. At such times, they talk about virtuous cycles or vicious cycles, self-feeding developments that will go on forever in one direction or the other. Here's a few quotes right before the Great Depression hit. There will be no interruption of our present prosperity. I cannot help but raise a dissenting voice to the statements that prosperity in this country must necessarily diminish and recede in the future. We are only at the beginning of a period that will go down in history as the Golden Age. The fundamental business of the country is on a sound and prosperous basis. That was President Herbert Hoover in October of 1929. So it's easy to see how people get swept up in this idea that things are different this time. Cyclicality is over. If I don't get in now, I'm going to miss out, because obviously everything is just going to go to the moon. Okay? Don't get swept up in that narrative. It's a very dangerous narrative. Ignoring cycles and extrapolating trends is one of the most dangerous things an investor can do. People often act as if companies that are doing well will do well forever. And investments that are outperforming will outperform forever, and vice versa. Instead, it's the opposite that's more likely to be true. So when you're looking at a company like Apple, when you're looking at Tesla, think to yourself, is it likely that these companies are going to continue the pace of growth that they've had over the last year? Or is it more likely that it's going to be cyclical, that they're going to come back down to earth? Think about that before, you can't help but being swept away by these companies, thinking, I'm going to miss out. I've already missed out on all of this growth. If I wait any longer, I'm just going to miss out more. I'm going to feel like more of an idiot. Really check that story. Check those thoughts against what Howard Marks is saying here. Right, the next time you're approached with a deal predicated on cycles having ceased to occur, remember that invariably that's a losing bet. Okay, such an incredible chapter, being attentive to cycles in this book, The Most Important Thing Illuminated. I read this book probably 3 or 4 years ago. I first listened to it on Audible, and I was like, holy crap, every other sentence in this book, I feel like I need to underline and highlight and reread and drill it into my psyche. So I had to buy the book right after I listened to the book on Audible. Literally, I've underlined like every other sentence. Highly recommended. So let me know if you guys enjoyed this. If you did, I'll go through more chapters in The Most Important Thing Illuminated. But either way, pick up a copy on Audible, pick up a hard copy, check this book out, digest it. It's full of wisdom that really can only be gained by decades in the markets, which Howard Marks has, and he's done incredibly well. Buying debt, distressed debt, is primarily what Howard Marks deals in. So I will leave you guys with that. I hope you had a safe and enjoyable Labor Day weekend, and I'll see you guys in the next video. Take care.